Hello everyone, my name is 𝗲𝘆 Assistant Manager from iFAST Research Team. The performance of S-REITs has been weak for a period of time due to higher interest rates and a challenging global macro environment. But for the performances of US office S-REITs, weak is probably an understatement. Investor sentiment remains in depression, reflected through share price declines between -60% and -80% from the peak within a year for the trio of US office S-REITs, Manulife US REIT, Prime US REIT, and Keppel Pacific Oak US REIT. First, let's take a look at Manulife US REIT. It first made headlines earlier this year when it announced a portfolio valuation decline of -10.9% as of 31st December 2022. Fast forward 6 months later, the valuation of its portfolio has declined yet again by a sharp -14.6%. Following this, its leverage was pushed to 56.7%, way above the MAS limit of 50%. In our view, investors should avoid initiating a position in Manulife US REIT as it is unlikely to pull out of its tailspin in the face of multiple challenges like high interest rates and a deteriorating US office market which affect property valuations and distributable income. Next, let's look at Prime US REIT. Its occupancy rate has tumbled to an all-time low of 58.6% since its listing in 2019. We believe that the leasing momentum in the US office market is unlikely to experience a quick rebound as many occupiers remain in a wait-and-see mode. Besides, the urgency to retain tenants often comes with costs. Currently, US office landlords have been offering higher concession packages in order to close lease transactions. While the weakening fundamentals of the REIT has been heavily discounted for by the market, we wish to caution investors that there is a lack of re-rating catalysts given significant uncertainties. Lastly, looking at Keppel Pacific Oak US REIT, it has held up better compared to its peers. Notably, despite the challenging operating environment, it managed to sustain an occupancy rate above 90%. The management also targets to maintain the rate above 90% by end 2023. Although we believe that it is in a better position to navigate through the challenges in the US office market compared to peers, we are also monitoring potential catalysts that could drive a re-rating. Such catalysts may include the stabilization of the portfolio and better than expected earnings in future quarters. Overall, we believe investors should avoid buying the dip on US office S-REITs as we see a lack of catalysts driving a robust and sustainable recovery. Particularly, the fundamentals are worsening for Manulife US REIT, which seems unlikely to pull out of its tailspin. We recommend investors to keep a selective and diversified approach. Investors can consider the 𝗪𝘰𝘃 S-REIT ETF, which has no exposure to US office S-REITs. To get the full analysis, scan the QR code or click on the link in the description below. Next up, Colin will share with us more about T-bills. Over to you, Colin.
Hi everyone, my name is Colin, Portfolio Manager at iFAST Research Team. Use of the Singapore Treasury bills, SITB in short, continues to diverge from US rates after tailing them higher for a year, since hitting a peak of more than 4.2% in late December 2022. Use of the 6-month and 1-year SITB have retreated while the Fed funds rate cracked the 5 handle. Since the start of this year, the Fed has relentlessly hiked policy rates by a total of 100 basis points over 4 meetings. In response to the hawkish Fed actions, shorter dated US Treasury yields have much higher throughout the first and second quarter. However, in Singapore, movement in SITB yields were much less aggressive. After dipping below 4% in the first quarter, SITB yields continued to decline throughout the second quarter, but inched higher in the back half of the quarter. That said, yields were less volatile and have started to stabilize. This carried over to the third quarter as the stabilization in yields continued. However, in recent months, SITB yields have also inched higher in response to higher US rates. The trend in SITB yields continued to reflect markets' expectation of an end in the Fed's rate hike cycle. In the previous 2 rate hike cycles between 2006 to 2008 and later between 2018 to 2020, yields for Singapore Government Securities plateaued and dipped before the Fed pause. We think this is playing out again, and the recent movement in yields makes sense when viewed in the historical lens. While an end to Fed's rate hike cycle may be approaching, we expect policymakers to hold rates at restrictive levels for longer. We believe policymakers lack strong intentions and have limited room to take their foot off the interest rate pedal in the near term. As the Fed maintains its hawkish stance, markets have also gradually pushed back their expectation of rate cuts to the first quarter of 2024. This is vastly different from 3 months ago when markets were pricing 2 to 3 rate cuts in the second half of this year. So as we approach the end of the Fed rate hike cycle, we believe SITB yields might not have much headroom to increase. That said, Fed funds rates staying higher for longer and a pushback in rate cuts should help keep SITB yields elevated. At the same time, higher for longer rates also suggest that investors have a longer runway to lock in yields, which are still attractive across history. For investors looking for low-risk options to park their cash, SITBs remains a good choice. The security is backed by the Singapore government and has a near-zero risk nature given its AAA credit rating. To get the full analysis, scan the QR code or click on the link in the description below. That wraps up for the sharing this week, and catch us again next week for more investment ideas and updates.